Hey, listen, when folks start their infinite banking system with us, one of the things they're going to get right in the beginning is their policy illustration. And then when the policy is issued, they're going to get a policy contract. Now, either one of these, when you look at it for the first time, you're going to be like, oh my God, what am I looking at? So let me explain this to you a little bit. What I want to do is I want to try to simplify this illustration for you in this contract so that you can understand it in basic terms. So if you're thinking about getting a policy, this video is definitely for you. But if you're actually somebody that has a policy, but yet you're still maybe a bit confused, this video is definitely for you. If you like cats like I do, say hi, Cash. Then go ahead and click that like button because we all would love to see how much you like kitty cats. So no matter where you're at, this video is going to give you a clear understanding on how the policy works and how to read it like a pro. Let's dive in. So we're going to look at a few different scenarios. We're going to look at a policy illustration that has no dump-in. Now a dump-in, like I explain all the time, is literally just taking money that's sitting in another account and just dumping it into the policy. And a lot of times a dump-in is just a one-time thing, moving money from your right pocket to your left pocket. So the first one I'm going to show you is no dump-in. Now all illustrations, what we do is we do a cash flow analysis, which looks just like this. It makes it a lot simpler to understand the numbers, and we give you basically the entire summary right from the illustration. All these numbers are derived directly from the illustration. And we also, on these, will show you what your plan design is. So we would call this one a 75-25. So what does that mean? That means that 75% of your premium is going to what's called a paid up additions rider. I'll get into that in a second. And that also means that the 25% is just going to the base whole life. So this is a 75-25. Over here you can see this is your annual premium deposits. And normally when we design these, we're going to design them the first 7 years for the set amount that the person wants to deposit. In this case, $12,000. What you'll see here is you'll see a slight drop. It goes from $12,000 to $11,833 in years 8 and 9. What is that? Well, that basically means that we drop the term insurance from the policy. Now in the 10th year on all the plan designs we do, this is where it's going to drop down to just base. So if I can, I'm just going to write base on here. The paid up additions are up here because really all we want paid up additions for is we want them so that you have high early cash value. In this one, you put $12,000 in, guaranteed cash value at the end of year 1 is $84.67, and over here, projected cash value with the dividend. So the only difference between guaranteed and non-guaranteed, and we'll get into this in a second, is the dividend. So the difference between this number and that number is simply the dividend. Then what we're going to do is we're going to show you projected premium to cash. Of the premium deposit you put in, of the $12,000, how much are you giving up to provide this death benefit over here? So you see we got a death benefit of $173,306 for this particular example. Well, you're giving up $2,694. So over here, this is a really important column. I always like to preface this on the one. Now, the illustration will not show this, but projected cash value growth per year. You put in $12,000, you got $9,306. Next year, you put in $12,000, you got $11,014. Then you put in $12,000, $11,574. And you can see right here, this is an important year. So 4 years after starting is when you hit your efficiency zone. You put in $12,000, you take more than 12 out. Now, the cool part about that is once you hit that point, 4 years, there's never going to be a year after that that you're not going to take out more money than you put in. And you can see that. Here's your premium. Here's how much you take out. So by the 10th year, you put in $32.77 in premium deposits, and you can take out $8,031. And then we do a neat little column here, projected cash on cash return. This shows you your return. So in this, you effectively lost money for the first 4 years because there was no dump-in. But then every year after this year, the 4th year beyond, you are in a positive cash on cash return. The other thing too we'd like to show is the projected death benefit. And we want to show you how much your death benefit goes up. Now remember I said here in year 8 we dropped a term. So you can see the negative amount. That's us dropping the term rider from the policy. So this is what we call our cash flow analysis. This is something that we do and we do for our clients only. If you just go to the insurance company or another agent, they're not going to provide this. So let's move on. So this is basically your illustration. Now you can see I've blacked out a bunch of stuff, but this is one of the companies that we use, which are all mutually owned, dividend-paying life insurance companies. This company is one of the top 5 rated life insurance carriers in the space. And this one, like I said, is the $12,000 premium deposit per year. And it's also a 75, we would call this a 75-25 design, okay? Let's move on to it. As we go into the first page of this illustration, you're just going to get into a policy summary. Now, all this is going to say is essentially that this is life insurance. So this is the most important line of the policy summary. Life insurance products are not bank products. Now, I know we constantly use the term private banking system, but what we're referring to is the system, the process called the infinite banking concepts. The policy is a whole life insurance policy that is designed and engineered to maximize cash value in the early years. That's what we do. So right here, it's stating that this is not a bank product and not a deposit. And they are not insured by the FDIC because that wouldn't be a banking product, nor any other federal entity. Have no bank guarantee and they may lose value. So what it's saying, and it may lose value. We'll talk about that in a second. In the event of any conflict, the provisions of this policy and the riders and not this summary shall control. So payments of benefits under the life insurance policy is the obligation of and is guaranteed by the insurance company. Guarantees are based on the claim paying ability of the insurance company and the sole financial responsibility for its products. So it's basically just telling you that this product is guaranteed by the insurance company and not guaranteed or insured like a bank account would be. Policy form is essentially just where it's telling you what it is you're buying. You're buying a level amount of insurance as long as the policy continues in force. Premiums are payable to age 75 years old. If the policy is still in effect when the insured reaches age 21, this is important, the policy will mature and we will pay the net cash value to you. That's called an endowment. That means the policy, when it's mature, you get paid the full amount. This page is just a narrative summary. It just shows you the guaranteed and the non-guaranteed values. So you can see the guaranteed values of the death benefit, cash value, and cumulative premium, of which, even on the guaranteed side, it just takes a little longer, the cash value exceeds the premiums. But you see the cash value and the death benefit level out at age 121. When you add the dividend, which is the only difference between guaranteed and non-guaranteed, what you see happens here is the cash value goes up much more than the guaranteed level because you got a dividend, and that increases the death benefit because this dividend is set to purchase paid up additions. Now this graph would look different if you set the dividend option as something different, but on every policy design we do, we set the dividends to purchase additional paid up additions, which is what drives the death benefit up. So now that looks a lot better, right? Look at the difference between right here, the premium and the death benefit and cash value. That's what we're looking for in these policies. Now I'm going to go fast through these. I don't want to bore you. I just want to kind of hit the baseline. So first line here on page 4 of 22 is premium information. So these premiums are illustrated in this one on an annual basis. And it's going to show you the first year modal premium is just a penny shy of $12,000. And it breaks it down if you did annual, if you did semi-annual, if you did quarterly, and you did monthly, because you can change that at any single time you want. The illustrations assumes that premiums are paid by you during the years 1 through 30. Premiums are paid in cash, out of pocket by you, and after the first 30 years, the policy becomes fully paid up and no further premiums will be paid by you. So this one we talk about all the time. Dividends. Dividends are not guaranteed. The guaranteed interest rate on the policy, which is in the contract, this is not the contract, this is just the illustration, but it's stated in the contract, but here it's just prefacing dividends are not guaranteed. So dividends could be lower, they could be higher, and just so you know, like this insurance company has paid dividends every single year the insurance company's been around, which is over 140 years. Then we get into policy loans, which we talk about all the time. We talk about taking policy loans, and you can see here that it's saying the loan is secured by the policy's cash value. We always tell you that the cash value is collateral for the loan the insurance company gives you from their general account. But down here, this is just going to go through and explain everything about that. Now, this is an important piece, and it's in bold, so I want to preface this.
interest that you pay to us, meaning the insurance company, is not credited to the cash value. A lot of people think when they pay the interest on the loan that it's credited to their cash value, but it's not. You're still earning interest and dividends because this particular company is a non-direct recognition company, so your full cash value is earning interest and dividends, but they're just telling you here that the interest you pay on the loan is not credited to the cash value and does not increase the cash value. Now up here, one other really important thing I want to show you is all the policies in the illustration will talk about the minimum loan interest rate, which is 0, and the maximum loan interest rate, which is 8. So the most this insurance company could ever charge you on the loan interest is 8%. Now it's not at 8% today. Okay, it's actually, depending on your policy design and your policy year, it's anywhere between about 4.75 and 5.35%. Okay, all right, moving on. Tax information. So what this is going to do is this is really going to go through and explain how life insurance is taxed. You're welcome to read this. You could have your CPA read this. I can't give you tax advice on anything, but a whole life insurance policy is in force, increases, the policy values are not subject to the federal income tax until a distribution is taken as defined by the Internal Revenue Code. Now, distributions are not loans. Distributions would be when we talk about taking a withdrawal. If you take a withdrawal from the policy, you can take withdrawals up to the amount of premium deposits you put in. They call that cost basis. But anything above and beyond that would be subject to taxes. Hence, why we would suggest or always tell you to take a loan so that you don't have to pay tax on that. Now, the other thing that is very important when it comes to the tax information here, and it's all covered, is the MEC 7 pay. Now, in every policy we design the policy right to the MEC 7 pay limits. And you can see that right here. The initial 7 pay premium for the policy, as illustrated, is $12,852. $852.25 is the amount above and beyond the $12,000 premium deposit that you told us you wanted to be able to put into the policy. So you don't have a whole lot of room to put more money in before you violate the MEC 7 pay rule, which then, right here, the policy, as illustrated, is not a MEC. If this becomes a MEC, you lose the favorable tax status, which is stated right here in the illustration. On the next page, it says if your policy is a MEC. It explains the different things you'd have to deal with. A policy would be subject to additional taxes and penalties on distributions during the policy's life. So you don't want that. So always make sure your policy is built within the proper MEC 7 pay guidelines, which is how we would design them. And then it's just going to talk about other important information. Dividend options on the illustration include paid up additions. I had mentioned that. So the way we're designing this policy and every policy for the most part is always going to be with dividends being applied to paid up additions, because that's what's going to increase your cash value and your death benefit like that graph showed. And then this one just shows you right here, the illustration has been prepared based on 100% of the company's current dividend scale. That's important because current dividend scale is what we're looking at every year in this policy. Now, dividends will change. So this policy illustration will be different into the future. Now, I can tell you right now, the last few years, we've seen dividend scales go up. So already, if dividends go up next year, this illustration would need to be redone and a new in-force illustration would need to be created for you so you can see exactly the impact of your dividend going up. The same would be true if your dividend went down, you'd want to get an in-force. But dividends will fluctuate, so therefore it's saying every single year this potentially could change. Okay, on this page, what it's going to do is it's going to give you the address for the insurance company. I blacked it out on this one. Okay, it's then going to talk about the riders. Okay, the additional riders. We didn't use this, but there's what's called a premium deposit fund, okay? The premium deposit fund would allow you to take a chunk of money, deposit it with the insurance carrier, and then the insurance carrier would use that deposited money to make your premium deposits. It's just an option that some people might benefit from. The other one here is called TLR 7. Now, this is just a 7-year term rider. Why 7 years? Well, remember the IRS rule, the MEC 7 pay rule, that's 7 years. So we need a term rider on the policy for a period of 7 years only. After the 7th year, we drop the term from the policy, which is going to reduce your death benefit. That's an important factor. The way we design these policies is to maximize cash value, not death benefit. So every policy we design is going to have a lower death benefit than a regular whole life would, but it's going to have significantly more cash value to use. All right, so before we go any further, let's just pause real quick, and I'd love to ask you to subscribe to this channel. There's a little bell up top. I would love for you to smash that bell, because it'll notify you every time I'm putting new content out, and that is definitely going to be something you're going to want to see. So now we're getting into more of the fine print, but this right here, LPUA, all that stands for is we're going to do a level premium paid up rider. So remember, we talk about paid up additions and base. Those are the two components, and then the third component is the term rider, which we already covered was the 7-year term rider to satisfy the MEC 7 payroll. So the paid up additions, what we're going to do is we're going to design your policy so that your paid up additions are part of every premium you do, which hence is the level premium. Now in this particular paragraph here, it's just explaining, and it also goes through the minimum annual for this. So there is a minimum, and it's $500 in this particular policy. So you got to at least do $500 a year. And right here, the first rider year and $120 each year thereafter. Now, the 120 is a really important number. Let's just say you built a policy and you built it for $12,000, but you wanted to reduce your premium deposit down to the bare minimum. That's fine. You have flexibility to go from the $12,000 down to the minimum and then back up to the $12,000. However, if you do that, you do not want to lose the ability to put paid up additions in later. Otherwise, you'll never be able to go back up. So in order to do that, you must at least deposit $120 a year or $10 a month into the paid up additions rider. That's essentially what's saying there. And then it's also saying the lifetime maximum is $5 million. Now, we can get exceptions on rare occasions for that, but just so you know, that's the provisions for the LPUA. Now, the next one right here is what's called an ADBR, Accelerated Death Benefit Plus Rider. Now, this is neat. This is one of the living benefits that comes along with all the whole life policies from this company. This rider allows for the acceleration of a portion of the policy's death benefit, provided that the insured qualifies for one of the benefit triggers. So you would probably ask, what are the triggers? Well, right here. The policy's death benefit and any net cash value received upon surrender will be reduced if this advance is paid. Upon receiving an advance, a special lien will be created against the death benefit of the policy. In other words, so whatever they advance you in this accelerated death benefit rider, that would basically create a lien against the full death benefit. So if you died, they'd pay out the net. Does that make sense? While outstanding, the lien will grow with interest. That's another thing to factor. They're going to charge interest on that lien. And they're also saying there could be an administration fee no more than $250 charged if you elected that accelerated death benefit. Now we're going to get into some of the key terms. Okay, these are all pretty simple, so we don't need to spend a lot of time on them. Annual date. Policies are policy date to policy date. So your issue date, the date the policy goes in force, is your now policy date. That's when your year starts. So if you started today, which is August 18th, your policy anniversary would start August 18th and go 12 months, and then that would be your renewal date. So that's just how that's explained there. Beneficiary is just the person that you want to receive the death benefit. Contract premium is the amount of premium you decide you want to put into the policy, which again, we talked about. There's paid up additions, term, and also base. So it's a combination of those three. Cumulative premiums, obviously the amount you paid out of pocket up to a specific date, and then death benefit. Death benefit's the amount that's payable to the beneficiaries that you choose. Dividends, we've kind of hit those already. So they anticipate a dividend will be credited annually because this is a mutually owned life insurance company. So therefore, they don't have stockholders to distribute profits to, so they distribute them or unused premium deposits. They don't call it profit because then it would be taxed. So it's unused premiums that were made to the company being returned. That's what your dividend is. Guaranteed elements means the premium, the benefits, and the values, which are guaranteed. And I mention this all the time. Your premium's guaranteed, your benefits, meaning your death benefits, are guaranteed, and your cash value on the guaranteed side is guaranteed. Illustrated scale is basically just saying they're going to illustrate it guaranteed as well as non-guaranteed elements, which include the dividend. And remember, the dividend is not guaranteed. Insured, that might be you. So if you're the insured body on the policy, that could be you, but it also could be a child. It could be anyone that you have an insurable interest. You can own a policy for your child, okay? Your child's the insured, you're the owner, which means you control it. So the next one here is the non-guaranteed elements. So non-guaranteed could be any additional premiums you're putting in, any additional benefits, like remember from the guaranteed to the non-guaranteed death benefit, and same thing with the non-guaranteed cash value. Essentially, the dividend in the effect the dividend has on paid up additions is the factor that's talking about there. The net cash value, everything we talk about, including when I showed you that cash value analysis that we did, okay, these are all net cash value. So what does that mean? Well, net cash value means the amount of money we will pay you upon surrender of the policy. So if you surrendered the policy and you didn't want it anymore, that's your net cash value. And the next one is paid up additions. So we've covered this pretty well. I mean, you can read this, but essentially it's just that additional paid up additions rider that you're going to put money into. And a lot of times we'll do a dump in into the policy, which I'll show you next. The dump in would be all paid up additions, okay? Premium outlay means the out-of-pocket premiums that you are putting into the policy, that you've elected to put into the policy. Surrender to pay premium. This is important, so I did want to hit this. It means the amount of paid-up additions surrendered each policy year. Where a 0 is displayed in the column, no surrender will occur. In other words, if you wanted to pay your premiums using your paid up additions, like your accumulated paid up additions, you can, and it's called surrender to pay premium. Now our clients typically do not do that. They would be like an emergency thing, but there's a lot of other options that would be used before surrendering to pay premium. 50% illustration scale. So this is something that would be the non-guaranteed dividends. Okay, so they're gonna sometimes, not always, it depends on the state you're in, sometimes the insurance company will show you the dividend scale being reduced by 50%. They typically would call that midpoint. On here, they're calling it 50% illustrated scale. And then the rest is just terminology. So now we're gonna get into some of the more fun parts of the illustration, and that is the numbers, the one thing that most people are gonna really focus on. So the numeric summary, this is where it's gonna break it down 5, 10, 20 into age 70. Again, all of this is what makes this illustration up. This is an illustration, but the cash flow analysis is derived from these numbers here. But let's just keep going. So this is the page you would sign. It's just gonna give you the values, but right here, I've got little tags on this, and that is gonna basically just show you that this is $12,000 for years 1 through 7. Then we drop the term, and you can see the term dropping when we look at the death benefit over here, because we went from $293,000 in death benefit to $215,000. That's us getting rid of the term. After that, you got a slightly lower premium deposit for 2 years. Then the 10th year, we drop the paid up additions. So this amount, the $3,277, is the base whole life. And once you hit that point, like at 10 years, and I don't care if we're looking at guaranteed or non-guaranteed, again, the difference between guaranteed and non-guaranteed is the dividend. It is the only difference. So no matter what you're looking at, you're gonna see that once we hit that 10th year, you're really making a lot. So here, you put in $3,277, the dividend alone would be $4,552, assuming dividends stay the same, and then your total increase in cash value, $8,031. And your death benefit's going up as well. So all the illustrations doing here on the tabular detail is showing you your net cash value, the increase in net cash value, which is the increase year over year, the dividend, and it gives you 2 columns, guaranteed, non-guaranteed, and shows you your death benefit on both. The next page is just a continuation. We're not gonna get too deep into the numbers, but here you can see 34 years in, your contract premium went to 0. Just like we read in that earlier part of the illustration, I apologize. Over here, after the 30th year, on the prior page, your premium goes to 0 and remains 0 until you get to 121. Now, if you make it to 121, like we mentioned, let's look at that real quick. If you get to 121, the insurance company is going to pay out the total cash value, which the cash value and the death benefit are the same. See that 1.748, 1.748. The death benefit and the cash value in the 121 year point, and when you basically reach 121, if you do, that's where the two balance out. This is another important page, additional information. I like to bring this out and describe this page. So over here, illustration assumes that premiums are paid by you. They're assuming that the premium deposits you chose are paid every single year as illustrated. And down here, this is just showing you the net payment cost index. I don't really get too much into that. I don't even really know how to fully explain that to you, but they're just calculations that they do. You can read that. But down here, this is something I fully understand and I want to explain. This is your premium information. Remember I said there's several pieces that make up your premium deposit. For example, the base. Now the base is the whole life, okay? The whole life is the most important part of it, but when we design this, we want the base to be lower because that's the most expensive part. And also, the base is what commissions are paid out on. So that you're paid commissions as an agent on the base, the 7-year term rider, and the PUAs, but you're paid the most on the base. So if we're trying to maximize high immediate cash value, we want to reduce the base down. So what we did in this one is we reduced the base down. Remember, 75-25. We want the base to be about 25%. In this case, it's actually 24% because we've got a term rider which accounts for $167 every year of the $12,000. So the paid up additions are 74, the premium base is 24%, and then the term rider makes up the difference to 100. So now you're 11,999.99. The minimum required, as you can see over here, is the base plus the term plus that $10 or $120. This is your absolute minimum that is required to run this plan. $3,286.99, and the max you can put in, $11,999.99. Remember, we looked at the MEC rule, it was $11,800 and something. That would be your absolute max, and if you breach that, the policy becomes a MEC. Now, as we go further into the illustration, what we're going to basically get into is a little bit of information about the underwriting requirements. So you could read that. It's just saying that they're going to require underwriting to issue this policy. A little bit of additional information. And then over here, we're just going to look at different things, different living benefits. Here, the living benefit that they're showing you is your chronic illness, your special medical condition policy values, your terminal illness policy values. So all of these riders are included with all of these whole life policies for this insurance company. And it's just going to give you the values, the max lump sum advance you can get for chronic illness, for specified medical condition, there's your max, and then for terminal illness, there's your max. So it just breaks down the amount you can get out of the policy while you're living for any of those living benefits, and then it just continues on and continues on until age 121. The final couple pages are just talking about max lump sum advances, again, explaining how they calculate and all the different considerations with those lump sum advances. And then in the last couple pages here, what is an accidental death benefit plus? When can I use it? Specified medical conditions, chronic illness, terminal illness. Because remember earlier when I was mentioning that, you were probably waiting for what does that mean? How do I trigger that? Well, here it is. All the descriptions of what would constitute an accelerated death benefit option. And then over here, how is your benefit calculated and how does that affect your policy? So we've gotten through the first policy illustration. And that was first, we went through the cash value analysis, which feeds from the illustration from the insurance company. Now, next, I want to just take a quick second and I want to show you the exact same policy design, but I want to show that policy design with a dump-in. So you can see here, everything's the same except for in the first year, we're going to dump in $100,000. Now, what's pretty unique here is if we were to compare these two, this is no dump-in versus dump-in, you look over here to your cash value and projected cash on cash return, see how much higher it is? We go from 77.55 with no dump in to 91.59 if we dumped money in. And some people would ask, why is that? Well, the reason for that is we have $100,000 earning interest and dividends and compounding that entire first 12 months, which makes a huge difference in the performance of the policy. Another reason why so many of our clients will do dump-ins if they're able. You don't have to. The policies will run efficiently with or without the dump-in, but if you did the dump-in, I mean, the numbers and the percentages that you earn go up significantly because we have more money compounding immediately. So let's move on to the illustration here really quick. Now, because I already ran you through this illustration once, we're going to really go through it quickly. Here, because of the dump-in, you can see huge difference in the beginning on both guaranteed and non-guaranteed, and that is because you dumped in $100,000, which increased the death benefit substantially, guaranteed and non-guaranteed, but it also bumps the cash value up right out of the hole. As we go through, I don't really want to cover too much except for we built this policy to not be a mech. So you can see this policy is illustrated is not a mech. If you go and try to have your insurance agent, maybe your advisor design one of these, they're gonna have a hard time designing this within the mech limits if they don't know how to do it properly. So be very careful who you allow to do this. As we start going through, all the language is gonna be exactly the same. So I'm just gonna go right over here to the design section. Now the design section, like we did before, is 3 components. It's gonna be your base, your term rider, your PUAs, your paid up additions, but also we're gonna add another one, and that is gonna be your single premium paid up addition, that lump sum dump in that we did. Now listen folks, I know this video is boring. It's boring for me to do it, but it's also informational because anybody that's doing one of these policies, they need to know how to read this illustration. So just bear with me. I'm gonna get through this, but I want to hit the most important parts so you understand what it is you're getting and how to read these illustrations. So down here, just like we did before, now I can actually do a comparison here. So let's just look at the base. Now remember, the only difference between this one and the other one is this dump in down here. So if I put them side by side, I know we're gonna kind of get sloppy here. I want you to notice the differences. Here's your dump in, 100,000, but because of the dump in, it required additional term insurance that we didn't need before to satisfy those MEC rules. So you can see here now, to satisfy that 100,000, we need $1.2 million in term insurance. So what we did is we actually needed more base too. The prior policy design with just 12,000 only needed roughly $55,296 in base, as you can see here. And then what we did is we did 100,000 in a term rider, and that's how the original was. Now, because we're dumping in $100,000, we absolutely need more death benefit. So we had to increase the base to $114,615, which means now the base only accounts for 50% of your total premium deposit, which is the same, $12,000, 2 pennies shy of $12,000. But now the base is only 50. And a lot of people are like, well, that sucks. I want a 75-25 like before. Well, the answer is you can't, because we can't design a 75-25 with this big of a dump in. We are redlining the policy is what we would call it. So also, your cost for the term is now 14.5%. We went from $167, which was the prior term's cost, to now $1,740. Now you can see why it's important to get rid of that term after the 7 years, which I'll show you in a second. And then the paid up additions are 35.5%. So that's your breakdown in the makeup of this policy. However, you would think because we've got less money allocated to paid up additions, the policy is not going to perform as well. But that's where you'd be wrong. Because we're dumping $100,000 right out of the hole into a single premium paid up additions rider, it's the same thing as putting money in the paid up additions. We're just accelerating that. And because we're accelerating that, the numbers, like I showed you before, are substantially higher and more efficient. Now, just like the cash value analysis, when we look at it, we dumped in 100 grand. So we got 112 going in right out of the hole, of which guaranteed at the end of year 1, we can take 99,326 or 102,576 out. And if you remember from the cash value analysis, that's 91.59% of the premium deposit you put in. Significantly higher, and that's higher because we've got more money working for you at the interest and dividend rate that the insurance company pays. But the second year, look at this. Year 2, we put 12,000 in. Year 2, we can take more than 12,000 out. You bump that efficiency zone up from year 4 to year 2 because, again, compounding interest. It's just mathematics, and the numbers get silly really quick. The third year, you put 12,000 in, you can take 13 out. You put 12,000 in the fourth year, you can take 14 out. Fifth year, you can take 15,000 out. 16, 17, 18, and you can see the numbers, they just keep going up. But then we reduce in the 7th year because we drop the term. So because we drop the term, we go from 12 to 10,260, but now in the 8th year, you put 10,260 in, and you can take out 18,000. If we come over here, and what did I say, the 8th year, and we look at the 8th year on your cash value analysis, that means that's 176.11% cash on cash return. Because if you put 10,000 in and take 18,000 out, if you figured the net, yeah, it's basically, that's your numbers. The downside to that number bumping up like that is we drop the term rider. So we lose 1.1 million and some change in death benefit. And you can see it over here as well. We go from 1.63 down to 451 in death benefit. But again, if you're designing one of these policies, you're designing it for maximum cash value efficiency, not maximum death benefit. That's a different discussion for a different day. So I just want you to see how, even though this design is not a 75-25, it's still more efficient because we dumped money in. And because we dumped money in, we had to play with the percentages so that the policy was not a mech. Now I want to show you one other thing here that we skipped over early on in the policy illustration. And that goes back to the tax section. And this is going to really wrap it up, and we're going to finish on this. Over here, this is the one with the $100,000 dump in. If you look here, the initial 7-pay premium for the policy as illustrated is $112,890.97. You see how tight that is? This policy is about as efficient as you can design a policy. And it is designed almost a 50-50 if you really looked at the numbers. $112,890, which means you can only put $890.97 above and beyond your stated premium deposit, which was $12,000. And that is about as efficient as I can build a design. And because of that, that policy design works very well for cash value growth and high early cash value, which are the two things we aim to do when we're designing these policies. So folks, I hope you've enjoyed this video. If you like this one, check this video out right here, how to design an IBC policy, and this is the updated one. Thanks for joining us for this episode. Hope you enjoyed it.